Stop what you're doing right now. What I'm about to reveal could change everything you thought you knew about your financial future. While you were enjoying your weekend, Russia and China have been making calculated moves in the shadows, and when Monday morning hits, the silver market might never be the same again. I'm talking about a potential seismic shift that Wall Street insiders are whispering about, but mainstream media won't tell you. By the end of this video, you'll understand why some of the world's smartest investors are quietly repositioning their portfolios right now. But here's the catch. If you don't understand what is happening in the next 25 minutes, you could be on the wrong side of history's biggest wealth transfer. So hit that like button, subscribe, and turn on notifications, because what you're about to learn is not financial advice, but it is information that could be absolutely critical for your future. Let me paint you a picture of what's really happening on the global stage right now. For decades, the United States dollar has been the king of the financial world. It's been the reserve currency, the safe haven, the backbone of international trade. But here's what most Americans don't realize, that dominance is being challenged in ways we haven't seen since World War II. Russia and China aren't just two random countries. Together they represent over 1.5 billion people and some of the world's largest commodity reserves. And they've been systematically preparing for what many analysts are calling the Great Dedollarization. Here's where silver enters the story. While everyone's been focused on gold, Bitcoin, and stocks, silver has been quietly positioning itself as the ultimate strategic metal. And Russia and China, they've noticed something that most Americans are completely blind to. Silver isn't just a precious metal, it's an industrial powerhouse. It's in your smartphones, your solar panels, your electric vehicles, your military technology. In fact, every single Tesla uses between 25 to 50 grams of silver. Every solar panel uses about 20 grams. And with the green energy revolution, demand is exploding. But here's the problem. We're running out. And before we go further, I want you to understand something critical. This isn't just about making money. This is about understanding a fundamental shift in global power dynamics that will affect every aspect of your life, from the technology you use to the stability of your retirement accounts. The decisions being made right now in Moscow and Beijing will ripple through the American economy for decades to come. Let me hit you with some numbers that should make your jaw drop. According to the Silver Institute, global silver mine production has been essentially flat for the last decade. We're talking about roughly 840 million ounces per year. Meanwhile, demand, it's skyrocketing. Industrial demand alone hit record levels in 2024, and analysts project it'll increase by another 15% in 2025. But wait, it gets better. Or worse, depending on which side you're on. The above-ground silver stockpiles that governments used to hold, they're mostly gone. The U.S. strategic silver reserves, depleted in the 1990s. We're now more dependent on annual mine production than ever before. And here's the kicker. Most silver isn't even mined as a primary product. About 70% comes as a byproduct of mining other metals like copper, lead, and zinc. So what happens when Russia and China, two of the world's largest resource holders, decide to restrict supply or hoard silver? You get a supply shock that could send prices through the roof. Now let me break down why this supply situation is even more precarious than most people realize. The global silver mining industry faces several structural challenges. First, ore grades have been declining for years. This means miners have to process more rock to extract the same amount of silver, increasing costs and energy consumption. Second, many major silver deposits are in politically unstable regions or face environmental restrictions that limit expansion. Third, and this is crucial, there's been massive underinvestment in silver exploration and new mine development over the past decade. When silver prices crashed in 2013-2015, many junior mining companies went bankrupt, and major miners shifted focus to other metals. It takes 7-10 years to bring a new silver mine online, which means even if prices surge today, new supply won't hit the market until the early 2030s. And here's something that should terrify supply chain managers: silver recycling rates. While significant, can't make up the shortfall. Unlike gold, which is mostly used in jewelry and can be easily recycled, silver gets consumed in industrial applications. When it's used in solar panels or electronics, it's often in such small quantities that recovery is economically unviable. Think about that. Every smartphone that gets thrown in a drawer, every solar panel that reaches end of life, that silver is essentially lost forever in practical terms. The International Energy Agency projects that solar panel installations need to quadruple by 2030 to meet climate goals. Electric vehicle production is expected to grow exponentially. 5G infrastructure requires silver. The industrial Internet of Things, more silver. AI data centers, they need silver-containing components. We're looking at a demand tsunami hitting a supply that can barely tread water. And before you think this is just speculation, let me tell you what's already happening. Russia has been playing the long game for years, and most Americans have been completely asleep at the wheel. First, the facts. Russia is one of the world's top silver producers, with annual production around 45 million ounces. But here's what's changed since 2022. After Western sanctions following the Ukraine conflict, Russia didn't just sit back and take it. They've been systematically building alternative trade networks, strengthening ties with China, India, and the BRICS nations. They've been moving away from dollar-denominated trade and into commodities-backed systems. And silver? It's become a strategic asset. Russian mining companies have been consolidating. The country's been investing heavily in domestic refining capacity. And here's the smoking gun. Reports from commodities, traders suggest Russia has been quietly restricting silver exports to Western markets while increasing flows to Asia. Why would they do this? Simple. It's economic warfare without firing a shot. By controlling silver supply, Russia can put pressure on Western manufacturing, support their Eastern allies who need silver for technology, potentially destabilize markets they've been pushed out of, build leverage in global negotiations. But let me dig deeper into Russia's strategic positioning, because this is where it gets really interesting. Russia has something most countries don't have: vertical integration in the metal sector. From mining to refining to manufacturing, they control the entire supply chain domestically. Companies like Polymetal and PJSC MMC Norilsk Nickel are not just producing silver, they're now prioritizing domestic use and friendly nation exports. There's another element most analysts miss. Russia has been conducting joint military exercises with China, and guess what component is critical for advanced military technology? Silver. From missile guidance systems to radar equipment, from electronic warfare systems to communication devices, silver's superior electrical conductivity makes it irreplaceable in defense applications. So when Russia restricts silver exports to the West while maintaining flows to China, they're not just playing economics, they're playing military strategy. They're ensuring their strategic partner has access to materials needed for defense technology, while potentially constraining Western military-industrial complex supply chains. And here's a detail that should make Pentagon officials nervous. There are reports that Russia has been stockpiling strategic metals, including silver, in secure facilities. They learned from Soviet-era mistakes when commodity shortages crippled industrial production. This time, they're preparing for a prolonged economic confrontation with the West. The sanctions regime that was supposed to isolate Russia, it's actually accelerated their pivot toward a commodities-based economic model. And silver sits right at the intersection of precious metal, industrial material, and strategic resource. And they're not doing this alone. China's moves are even more calculated. If Russia's playing chess, China is playing 5D chess, while everyone else is playing checkers. Let's talk numbers first. China is the world's third largest silver producer, mining about 110 million ounces annually. But more importantly, China is the world's largest consumer of silver, using roughly 200 million ounces every year. Think about that. They produce 110 million, but consume 200 million. That's a deficit of 90 million ounces they need to import annually. So what's China been doing? 3 things that should terrify Western policymakers. First, strategic stockpiling. Chinese state-owned entities and banks have been accumulating silver at unprecedented rates. The Shanghai Gold Exchange, which also trades silver, has seen massive withdrawals from warehouses, indicating buyers are taking physical possession rather than just trading paper contracts. This is huge, but let me explain what this really means. When Chinese entities take physical delivery, that silver leaves the global market. It gets stored in vaults in Shanghai, Shenzhen, and Beijing. Unlike Western investors who might flip positions based on short-term price movements, Chinese strategic buyers have a long-term horizon measured in decades, not quarters. There's evidence that Chinese sovereign wealth funds and state banks have been using price dips to accumulate. Every time silver drops below certain thresholds, buying pressure from Asia mysteriously appears. This isn't retail investors or speculators. This is institutional strategic accumulation. Second, controlling the supply chain. China dominates solar panel production, which accounts for 75% of global output. They dominate EV battery production. They dominate electronics manufacturing. All of these require massive amounts of silver. By controlling downstream industries, they control silver demand and can influence global pricing. Let me paint you the full picture of how deep this control goes. China doesn't just manufacture solar panels, they control the polysilicon production, the wafer manufacturing, the cell production, and the module assembly. The entire solar supply chain runs through China. And here's the brilliant part. China can use silver supply as a competitive weapon. If they secure preferential access to silver from friendly nations like Russia, they can produce solar panels and EVs more cheaply than Western competitors, who have to pay higher prices on constrained markets. This gives Chinese companies a structural cost advantage that no amount of innovation can overcome. Think about the implications. American and European green energy companies become dependent on Chinese manufacturing because Chinese firms have guaranteed silver supply at better prices. This isn't just about one commodity, it's about controlling the entire green energy transition. Third, creating alternative markets. China's been building the Shanghai silver benchmark, challenging Western price discovery mechanisms like the London bullion market. They want to set silver prices on their terms, denominated in yuan, not dollars. This is about more than just where prices are set. This is about who controls the fundamental infrastructure of commodity markets. For decades, London and New York have been the centers of precious metals pricing. China wants to break that monopoly. The Shanghai International Energy Exchange, the Shanghai Gold Exchange, these are all pieces of a broader strategy to create one denominated commodity markets. If China succeeds in making Shanghai the primary price discovery venue for silver, they can influence global prices, reduce dollar dependence, and gain geopolitical leverage. There's also the Belt and Road Initiative angle. China has been investing heavily in mining projects across Africa, Latin America, and Central Asia. Many of these projects include silver as a byproduct. By securing offtake agreements and providing financing, China is essentially locking in future silver supply before it even comes out of the ground. And here's the Sunday night alert that should wake you up. There are unconfirmed but credible reports that China and Russia have been in discussions about coordinating their silver policies within the expanded BRICS framework. Imagine a scenario where the two countries collectively decide to restrict exports, increase domestic purchases, or create a commodities-backed trading system using silver as a component. The impact would be immediate and massive. With the BRICS expansion, including countries like Iran, Saudi Arabia, UAE, and potentially others, we're looking at a commodity bloc that could rival Western markets in size and influence. If this bloc coordinates on strategic resources like silver, the current global trading system faces disruption on a scale we haven't seen in generations. Now, before you think this is unprecedented, let me give you some historical context that proves this playbook has been run before. Remember the 1970s oil crisis? OPEC nations coordinated to restrict supply, and oil prices quadrupled virtually overnight. The impact on the American economy was devastating. Gas lines, inflation, recession, that was just oil. Imagine if multiple strategic commodities face coordinated supply restrictions simultaneously. Or go back to 2010, 2011, when China restricted rare earth element exports. These materials are crucial for everything from smartphones to military equipment. Prices skyrocketed by 1,000% in some cases. The US and other nations scrambled to develop alternative sources, but it took years. During that time, China leveraged its monopoly for strategic advantage. The Hunt brothers' silver corner in 1980 is another instructive case. Two private investors nearly cornered the silver market, driving prices from $6 to $50 per ounce. Eventually, regulators intervened and the scheme collapsed, but for a brief period, they demonstrated how a coordinated effort to control silver supply could send prices to the moon. Now imagine that scenario, but instead of two billionaire brothers, it's two of the world's most powerful nations with virtually unlimited resources and long-term strategic patience. The Hunt brothers had to worry about margin calls and regulatory pressure. Nation-states don't have those constraints. There's also the nickel market chaos of 2022 as a recent example. When Russian nickel supplies faced sanctions, prices spiked so dramatically that the London Metal Exchange had to halt trading and cancel trades. A major Chinese tycoon faced billions in losses. The entire global nickel market was thrown into chaos over supply concerns from just one country. Silver markets could face similar dynamics, except silver has both precious metal characteristics and industrial necessity. The potential for disruption is even greater. History teaches us that commodity supply shocks happen more frequently than people expect, and when they do, the price moves are violent, sudden, and often long-lasting. The question isn't if this could happen to silver. The question is when, and are you positioned for it? Okay, so Russia and China are making moves. Why should you, sitting in your home in America, care about this? Let me break down the domino effect. Domino number 1, price explosion. If supply gets restricted or hoarded, basic economics tells us prices will surge. We're not talking about a 10% or 20% increase. Some analysts are predicting silver could triple or even quintuple from current levels if a true supply crisis emerges. For investors who positioned early, that's generational wealth. For those who waited, priced out. Look at what happened to lithium prices when EV demand surged. From 2020 to 2022, lithium carbonate prices increased by over 500%. Silver could follow a similar trajectory if industrial demand continues accelerating while supply remains constrained. The difference is, lithium has alternatives in some applications. Silver's unique properties make it irreplaceable in many uses. Domino number 2, industrial disruption. Higher silver prices mean higher costs for solar panels, EVs, electronics, medical equipment, and defense technology. This could slow down America's green energy transition and make us less competitive globally. Your iPhone could cost more. Your electric bills could rise. The ripple effects are endless, but it goes deeper than just prices. If silver becomes genuinely scarce, we could see manufacturing bottlenecks. Companies might not be able to secure enough silver to meet production schedules. Product launches get delayed, economic growth slows, jobs are affected. The US already faces supply chain vulnerabilities that were exposed during the pandemic. Adding a critical industrial metal shortage to that mix could cripple sectors that are vital to American competitiveness. Domino number 3, dollar weakness. If Russia and China successfully create alternative trading systems using commodities like silver, it further erodes dollar dominance. This means higher inflation for American consumers, less purchasing power, and potential geopolitical instability. The dollar's reserve currency status has given Americans a tremendous advantage for decades. It means lower interest rates, ability to run trade deficits, and economic resilience. But that status isn't guaranteed forever. Every commodity market that shifts away from dollar pricing chips away at that foundation. If silver trading increasingly happens in yuan or in direct commodity-for-commodity exchanges that bypass dollars entirely, it's another brick removed from the dollar's fortress. And when the fortress starts crumbling, Americans will feel it in their wallets every single day. Domino number 4, geopolitical leverage. Control of strategic resources translates directly into geopolitical power. If China and Russia can weaponize silver supply, they gain leverage in international negotiations, trade disputes, and diplomatic conflicts. The United States could find itself in a position of dependence on nations that don't share American interests. This affects everything from Taiwan policy to Middle East strategy to climate negotiations. When you need critical materials from someone, you can't afford to antagonize them too much. That's not the position America wants to be in. Domino number 5, investment opportunities. On the flip side, for those who understand what's happening, this represents one of the biggest investment opportunities of the decade. Not just in physical silver, but in mining companies, silver streaming firms, and related sectors. Companies that control silver deposits, have strong balance sheets, and can ramp production could see their stock prices multiply. Silver streaming companies that have locked in favorable contracts could generate outsized returns. Even peripheral industries like secure storage facilities could benefit. But here's what you need to understand. Timing matters. The window of opportunity before this becomes mainstream knowledge is closing. Once CNBC and Bloomberg start talking about this 24/7, the easy money will already be made. The smart money is always early. They position before the crowd arrives. They're willing to be patient. And they understand that the biggest returns come from seeing what others don't see yet. So what's the average American supposed to do with this information? First, let me be crystal clear. I'm not a financial advisor, and this is not financial advice. You need to do your own research and consult with qualified professionals before making any investment decisions. But here are some educational points to consider. Education. Step number 1, understand the market. Don't just take my word for it. Research the silver supply demand fundamentals. Look at the Silver Institute's reports. Follow commodities analysts like Jeffrey Christian at CPM Group, David Morgan of the Morgan Report, or institutional research from Goldman Sachs and Bank of America. Understand both the bull and bear cases. Knowledge is your first line of defense against making emotional decisions. Read the annual reports of major silver miners like First Majestic, Pan American Silver, or Wheaton Precious Metals. Understand their production costs, reserve levels, and growth plans. The more you know about the industry fundamentals, the better equipped you'll be to make informed decisions. Education. Step number 2, consider your risk tolerance. Precious metals can be volatile. Silver especially can swing wildly. Any position you take should be something you can afford to hold for the long term and won't keep you up at night. Never invest money you can't afford to lose. Ask yourself, what percentage of your portfolio can you allocate to a speculative opportunity? What's your time horizon? Can you handle 30-40% drawdowns that might occur before the thesis plays out? Are you investing or speculating? There's a difference, and being honest with yourself about which one you're doing is crucial. Education. Step number 3, explore different options. If silver interests you, understand there are multiple ways to gain exposure. Physical silver, coins and bars. You own the actual metal, maximum control, but storage and insurance costs apply. Premium over spot price can be significant. Liquidity varies by product. Silver ETFs, paper silver. Easy to buy and sell, low costs, but you don't own physical metal. Risk of tracking errors or management issues. Examples include SLV, PSLV. Understand the difference between physically backed ETFs and futures-based products. Mining company stocks, leverage to silver prices, potential for outsized gains, but also company-specific risks like operational problems, management quality, geopolitical risks if mines are in unstable regions. Diversification across multiple miners can reduce company-specific risk. Silver streaming companies. Companies like Wheaton Precious Metals buy future production from miners at discounted prices. Less operational risk than miners, but still exposed to silver prices. Often have strong balance sheets and dividend potential. Silver futures, advanced, risky, high leverage, potential for massive gains or losses, requires significant knowledge and risk management. Not appropriate for most retail investors. Margin requirements and daily settlement create unique risks. Each has different risk profiles, liquidity, and tax implications. Understand the tax treatment in your jurisdiction. Physical silver and mining stocks are taxed differently. ETFs have their own tax considerations. Education. Step number 4. Think strategically. If the Russia-China scenario plays out as some predict, this isn't a quick trade. This is a multi-year structural shift. Position sizing and patience become crucial. The investors who win aren't those who go all in on a hunch, but those who build positions strategically over time. Consider dollar cost averaging if you decide to build a position. Buy consistently over months rather than trying to time a perfect entry. This reduces the risk of entering at a local peak and smooths out volatility. Think about your exit strategy before you enter. At what price or under what conditions would you take profits? What would invalidate your thesis and cause you to exit at a loss? Having a plan prevents emotional decision-making when markets get volatile. Education. Step number 5. Stay informed. Follow developments in BRICS nations, commodity markets, and geopolitical tensions. Set up news alerts for silver market news, Russian and Chinese commodity policy, and alternative currency systems. Information is power, and in fast-moving markets, staying ahead of the curve matters. Quality information sources matter. Follow commodities-focused publications, read research reports from mining analysts, watch interviews with industry insiders. The mainstream financial media often misses or underreports commodity market dynamics until it's too late. Education. Step number 6. Understand the risks. Every investment thesis has risks. For silver, those include price manipulation or suppression through paper markets, technological substitution, reducing industrial demand, major new discoveries increasing supply, economic recession, reducing industrial consumption, government intervention or regulation, your thesis being completely wrong. Acknowledging these risks doesn't mean avoiding the opportunity. It means going in with eyes open and appropriate position sizing. Now, I want to be intellectually honest with you. Not everyone agrees with this thesis, and you deserve to hear the counterarguments. Skeptics say silver has had false breakouts before. In 2011, silver hit nearly $50 per ounce, and many predicted it would go to $100 or higher. Instead, it crashed and spent a decade in a bear market. Doomsday scenarios rarely play out as predicted. Markets have a way of finding equilibrium even when supply-demand fundamentals look dire. Central banks and governments have tools to manage commodity supply shocks. Strategic stockpile releases, trade policy adjustments, subsidies for exploration and production, even direct market intervention. Betting against the ability of governments to manage these situations has been a losing trade historically. Technology might reduce silver usage through substitution or efficiency gains. Engineers are constantly working on ways to use less material or find alternatives. Copper could substitute for silver in some applications. Nanotechnology might allow for much smaller amounts of silver to achieve the same results. Russia and China have their own economic problems and may not coordinate as effectively as bulls believe. Russia faces sanctions pressure, demographic decline, and economic stagnation. China is dealing with a property crisis, debt overhang, and slowing growth. Coordinating complex commodity market manipulation while managing domestic challenges might be beyond their capability. Paper markets, futures, ETFs, can artificially suppress prices regardless of physical dynamics. If trading volumes in paper silver dwarf actual physical supply, price discovery happens in the paper market. This could prevent physical shortages from translating into price spikes that theory would predict. Some analysts argue that silver's industrial demand, while growing, is still a small percentage of total material costs in most end products. A solar panel uses $5 to $10 worth of silver. Even if silver doubles, it adds minimal cost to the final product, meaning demand might be more price inelastic than bears assume. These are valid points that serious investors consider. The truth is, nobody has a crystal ball. Markets are complex, geopolitics is unpredictable, and what seems obvious in hindsight is never clear in real time. What I'm presenting is a scenario based on observable trends and logical deduction. It might unfold exactly as described, partially or not at all. Your job as an informed individual is to weigh the evidence, consider multiple perspectives, and make decisions aligned with your personal circumstances and risk tolerance. The best investors are skeptical of everyone, including themselves. They constantly challenge their assumptions, look for disconfirming evidence, and adjust their views as new information emerges. So let me bring this home for you. We've covered a lot of ground today. Russia and China are making strategic moves in the silver market. Supply is tight, demand is exploding, and the geopolitical landscape is shifting in ways that could create perfect storm conditions for a silver price surge. Whether you choose to act on this information or not, at least now you're aware. You're ahead of 99% of people who have no idea these dynamics are even in play. This Sunday night alert isn't about creating panic. It's about creating awareness. It's about giving you information that mainstream media either does not understand or doesn't want to discuss because it doesn't fit their narrative. The wealthy and connected always have information advantages. They know what's coming before it makes headlines. My goal with this channel is to level that playing field, even just a little bit. Let me leave you with a final thought. Throughout history, massive wealth transfers have occurred during periods of monetary uncertainty and commodity disruption. In the 1970s, those who owned gold and commodities preserved and grew their wealth, while currency holders lost purchasing power. In the 2000s, commodities boomed. Savvy investors made fortunes, while others missed out entirely. We might be entering another such period. The monetary system is under stress. Dedollarization is real, even if gradual. Supply chains are vulnerable. Geopolitical tensions are rising. And specific commodities like silver sit at the intersection of all these trends. You don't need to bet your life savings on this thesis. But you do need to be aware, informed, and thoughtful about how you position yourself financially over the next few years. The decisions you make today, based on the information you have access to, will determine which side of the wealth transfer you end up on. That might sound dramatic, but it's historically accurate. Every major economic transition creates winners and losers. The winners are usually those who saw the transition coming and positioned accordingly. So here's what I want you to do right now. Action number 1, smash that like button if you found this valuable. It helps YouTube show this to more people who need to see it. Action number 2, subscribe and hit the notification bell. This situation is developing rapidly, and I'll be bringing you updates as new information emerges. I'm tracking BRICS meetings, Russian and Chinese policy announcements, silver market data, and geopolitical developments that could accelerate this thesis. Action number 3, share this video with someone who needs to see it. Your friends, your family, anyone who cares about their financial future. This isn't information that should stay isolated. The more people who understand these dynamics, the better prepared we all are. Action number 4, drop a comment below. Tell me, do you think Russia and China can actually pull off a silver market disruption? Are you considering adding silver to your portfolio? What questions do you have? What did I miss? I read every comment, and your engagement helps shape future content. Some of my best video ideas come from viewer questions. Action number 5. Check out the resources I've linked in the description below. I've included links to the Silver Institute's annual reports, commodities research from major banks, educational materials about precious metals investing, and links to follow geopolitical developments. Do your own research. Verify what I've told you. Make informed decisions. Action number 6. If you want to go deeper on this topic, check out the videos and the cards popping up on screen right now. I've got content on BRICS expansion, de-dollarization trends, precious metals fundamentals, and geopolitical risk analysis that will give you even more context for understanding these developments. Remember, this is a Sunday night, which means Monday morning is coming fast. Markets open, decisions get made, and opportunities either appear or disappear. Whatever you decide to do, make sure it's an informed decision. Do your research, talk to professionals, talk to people who disagree with this thesis, challenge your own assumptions, and never invest based solely on YouTube videos, including this one. The world is changing faster than most people realize. Russia and China are making moves. The silver market is approaching a potential inflection point, and you now have information that puts you ahead of the curve. What you do with that information, that's entirely up to you. But at least now you can't say you weren't warned. At least now you have a framework for understanding events as they unfold. At least now you're thinking about scenarios that most people won't consider until it's too late. Stay curious, stay informed, stay skeptical, and most importantly, stay strategic about your financial future. Until next time, stay informed, stay strategic, and stay ahead of the game.